So in today's video, we'll take a look at the ASX stock Afterpay and review its inception, news, past performance, and current environment to hopefully give you an understanding of the stock before you decide to invest in it for good. I'll try to present everything in a factual and unbiased way because we want to leave emotions at the door when we make any investment decisions. So, is the buy now pay later darling stock that's seen an 800% increase in its stock price still worth it? Is it not too late to get in on the action? Well, let's jump right in. Afterpay was founded in January of 2015 by Nicholas, who was managing an online jewelry store on eBay, and his then neighbor Anthony, who was the executive director of an investment holdings company, Guinness Peat, at the time. The initial version of Afterpay was to give retailers an online platform to manage their lay-by sales. If you don't remember, lay-by was similar to the buy now pay later service, but you only get the product after you've paid all the installments. Anyway, Afterpay quickly partnered with a payments company called Touch Corp, which was formerly owned by Anthony's Guinness Peat investment company that could process all of Afterpay's payments. And with that, the first use of Afterpay went live on a jewelry website called iceonline.com.au, which still has a big Afterpay logo on the front. Within 6 months, they managed to get 15 retailers to use the payment system, which is a remarkable feat for such a young company. With its continued momentum and racking up more and more retailers for another year before Afterpay was floated on the ASX in April of 2016 for, wait for it, $1 a share. Looking at that with the 2020 lens, it was such a bargain back then, and don't you all wish that you bought some back then? Even within the first 3 months of the float, its price went up 150%. Let's fast forward another year, and Afterpay managed to get big contract deals with big retailers like Myer, Officeworks, Country Road, Super Retail Group, Big Commerce, and Big W. Throw in a partnership with Tyro Payments, who provides retailers with EFTPOS payment machines, and Afterpay has pretty much set itself up to be able to integrate with every retailer's point of sale, even if they haven't signed contracts with them yet. While all of this happened, Afterpay's share price stayed pretty much the same for the next year, but that's only until the announcement of the Touch Corp Afterpay merger was allowed by the court hearings. This was pretty much a given considering Afterpay was expanding its market share exponentially but still relied completely on Touch Corp to process all of its transactions. So with that, in July of 2017, AFY closed trading at $2.74 and TCH closed trading at $1.67 to form APT that we know today and began trading again at $2.95. Afterpay's momentum right through to August 2017 was very strong, more than doubling its customers in only 8 months to over 1 million users and 5 million transactions since it began, which means customers are using it on average 5 times after signing up. This is important because it means that people aren't just using it once and ditching it. Now, with 7,200 retailers offering the service on behalf of Afterpay, the company was able to produce $23 million in merchant fee revenue. But they weren't done yet. Retail was only a small slice of the pie because they had eyes on a new sector which was expected to be twice as big as retail: travel. The first partnership to be revealed was Jetstar, the budget airline of Qantas. This was big news because it set precedents for airlines to open its gates for the buy now pay later market, and Afterpay's stock price also rode this news upwards. So naturally, the next step was to target the other budget airline Tigerair before moving on to the big guns Virgin and Qantas. So in March of 2018, the announcement of the now extinct Tigerair offering a buy now pay later option was made in partnership with ZipPay. Yeah, that wasn't supposed to happen. And the stock price took its first significant dip from $7.50 down to $5.50. This was only temporary though because the strength of its retail arm was so strong, with merchant fee revenue increasing to $37 million, and the entrance of Afterpay for the US market was also announced soon after, so the stock price recovered quickly. This bull run was ended 5 months later because Virgin Australia also signed with, you guessed it, ZipPay as well. But again, the price dip was temporary because of successes in retail partnerships locally, and more overseas success in the US market as well. Fast forward to 2019, and a strong economic growth meant strong consumer spending, which naturally aligns with increased earnings and therefore increasing stock price. The first half financial year results of 2020 reports continued growth in Australia, with sales increasing to more than $3 billion, an increase of 55% from the year before. The US market also generated a massive $1.4 billion in sales, which is a phenomenal 455% increase from the year before, and the user base already exceeding that of Australia's. The early ventures in the UK market under the brand Clearpay picked up a respectable $200 million in sales, already with over 600,000 users. Things were looking so good, but remember, this was February 2020, and we all know what happens next. On March 23rd, at the height of the situation, the stock price reached as low as $8.90, but that was when the economy recovery began. At first, the recovery was in line with most other stocks, right up until May the 1st, because that's when a massive announcement was released. Tencent, one of the world's largest video game companies, one of the world's largest social media companies, one of the world's largest venture capital and investment holding companies, had invested $300 million to buy a 5% stake in Afterpay. This was massive for the company because it allowed them to tap into the knowledge of the world's most successful digital platform and apply it to their own. And investors crammed in on the back of this news to drive the stock price higher than it had ever been before. This was covered in all the news outlets and happened at a time when new ASX investors were joining the stock market in record numbers. The stock price continued to rise on the back of continued success in the US with 5 million active users, and in the UK with 1 million active users, equating to increased sales and revenue. But what about its competitors? Well, its direct rival is easily ZipPay, who has seen similar meteoric rises in their earnings and as a result its stock price. The story behind Zip is quite interesting as well and probably needs a whole video to cover. The other smaller competitors in Australia are Splitit, Sezzle, Openpay, and most notably the Swedish company Klarna, which has the backing of CBA. Perhaps the goal for CBA is to make the buy now pay later function integrate directly with their banking app, which may give Afterpay a run for its money. Klarna is also the dominant buy now pay later service in the UK. In the US, the biggest hurdle to Afterpay is Shopify, which is almost a carbon copy of the 4 equal interest-free installment model that Afterpay uses. So as you can see, the buy now pay later sector actually has very little barriers to entry and is very, very crowded. There's no doubt that the competition will be fierce and only 1 or 2 in each country will come out on top. Also, the biggest hurdle for all these companies are the credit cards, which, when you think about it, are also buy now pay later cards which have been around for much, much longer. And if someone already has a credit card which offers points for spending, why would they use Afterpay? It would make no sense to use both either because they are paying an annual fee and need to make that back through the rewards program. So, what does the future hold for Afterpay? Whilst the growth and expansion into new markets is very promising, the market is really only limited to people who 1. Don't have a credit card, 2. Have minimal savings and need to wait for paychecks, and 3. Are technologically savvy. This really only points to one group, the millennials, who, by Afterpay's own financial reports, make up the biggest proportion of users. Since the concept is still quite new, the novelty is there for all the millennials signing up in recent years. Afterpay has been called the ASX tech darling stock so many times, but how long would that last? Because it's very possible that this concept is likely going to wear off and hit a plateau eventually. When will that be? Well, we can only guess now and find out later. Thanks for watching the first of these types of videos. I try not to go into the financial figures and capital raises too much because there are already so many videos that do that already. So anyway, I already can't wait to make the next one about an ASX company, so definitely hit that subscribe button so you'll be notified as soon as I release one. And leave a comment if you want to see a video on your favorite company, and I might just choose it on the next release. Thanks again for watching, and I'll see you in the next video.